There are different investment strategies that you can use to improve the return that you're getting from your investments. And that is what we're going through today. Hi, my name is James Coursier and welcome to the Money Paradox. Welcome to today's video, and yes, that's right, we're going to go through some really important strategies that you can apply to how you invest to improve the returns you're getting, to improve how much those investments are aligned to what it is that you're doing and what you want to achieve from those investments. Okay, and then as part of that, we're going to then say, okay, so what are those techniques that we need to incorporate into how we invest? And then based on that, how do we put our own investment strategy together? And then what are the kind of key rules that we need to be following to make sure we're doing it in an effective way? Cool, so let's jump in. So first thing I want to talk through is diversification. So diversification essentially is investing in different things, right? So if you put all your investment money into one thing, then if it goes up, then all your money goes up. But if it goes down, all your money goes down. Or if it goes to zero, all your money goes to zero, right? You know that saying, all eggs in one basket? You know, that's kind of like the opposite of diversification. Diversification, the aim of it is you're putting money into different things so that if one thing goes down, your whole investment kind of pot, or, you know, a more complicated way of saying it is portfolio. You know, all of the things that we're invested in isn't going to go down, right? Because they're in different things, right? We'll go into that in a little bit more detail. But that's basically what it is. Second thing is asset allocation. Asset allocation is what we're allocating, so what we're putting in each of the different assets. So an asset is like a different thing we can invest in. So for something to be an asset, we're essentially saying that it's something that you think you're expecting it's going to bring you a return, a benefit from putting money into it, right? So, you know, if I put some money into the stock market and I'm expecting the stock market to go up, that's an asset. If I'm lending money to the government, and the government, I'm expecting the government to kind of give me my money back plus some more for the privilege in the future, then that's an asset as well, right? Real estate, property, that can kind of be both, right? That's why it's a super complicated, not complicated, but controversial topic. If you invest in a property and you're expecting that property to give you money kind of over the future, like through rent, or it's supposed to go up in value over time, right? And so you're going to increase the amount of money you're worth as a result of having that property, then it's an asset. But if you buy a property and it's costing you money every month to maintain that property, the property may go down in value, right, because of some kind of crash, then actually that property could be a liability. Yeah. So a liability is like the opposite of an asset. An asset allocation is how you're allocating your money into each of these different types of investments. That's it, right? Ratio, in its kind of purest sense, is one thing compared to another, right? So if I have 2 blue chips and 4 green chips, then I have a 2-to-4 ratio of green to blue chips, yeah? Or a kind of a 1-to-2 green to blue chip ratio, right? 2-to-4, half that is 1-to-2. So ratio from an investment point of view is the ratio of what money is in each of those different assets. So for example, if I have, you know, £10,000 in some property, and then I have, I don't know, £5,000 in the stock market, as an example, then, you know, there's 10,000 in property, 5,000 in the stock market. That's a 10-to-5 or a 2-to-1 ratio of property or real estate to the stock market, 2-to-1, right? So we'll come on to why that's important, but it's essentially kind of explaining the weighting between each of the different things that you have money in, okay? Because you might say, oh yeah, I've got money in stock market, in bonds, in gold, in property, in crypto. I might have money in all these different things, right? So I'm diversified, I'm in all these different things. But if the ratio is kind of like all over the place, right? Like I have like, £10 in the stock market. I've got like £100 in some kind of property related investment. And then I've got like £10,000 in, say, Bitcoin, right? Well, I might say, yeah, I'm diversified. I've got lots of different things. But really, the ratio there is like completely off. It's like 1,000 Bitcoin to like one property or stock market, yeah? So the ratio between what you're putting in is important too, okay? And then the last one I want to cover off is tax, right? So like, I mean, you can just say the word tax and everyone just kind of like snores, like, tax, it's so boring. Kind of is boring. I mean, there's a limit to how much I can kind of chat about tax. But like, it's kind of interesting in a way, if you're good at it, if you're good at like understanding it and like managing your money around it, then you can, save money, right? I mean, that's kind of cool, yeah? So you can have like more money to spend on stuff you like. I mean, that's nice. So, tax in some ways is kind of a cool subject, right? Okay, no, it's not. I mean, it's like super boring. But like, it's really important. It's really important when it comes to investing. Because depending on what you invest in and how you invest in it, when you invest in it, then like the tax implications of that can vary enormously. And the amount of tax you pay can vary enormously. Like that's like a really big factor in like what you do, in how you invest, but also like how you make your money, how you earn your money. Like, I just think this is a subject that a lot of people really don't spend the kind of time like they need to like make the most of it, right? They're just like, I've just got to pay taxes. So I just pay whatever, or like, I just don't want to think about it. I'm just gonna kind of do what I want to do, and then find out what the tax implications of that later is, and then and then just pay that. I mean, that's fine. I get it. People don't want to do stuff that's like not that interesting. But if you think about it smartly from a tax point of view, then you can like reduce your taxes and then have more money to spend and do what you want, and ultimately become financially free quicker, right? If you're spending less money on taxes, then that's more money to build and accumulate into the kind of wealth we need to be financially free. Now, the question I get back a lot is, oh yeah, but James, you can't like try and reduce your tax. You can't like avoid tax. That's like immoral and bad and like naughty. And I like giving money to the government because then I'm supporting the government, and like that's the right thing to do as a British citizen or whatever country you're from. Yeah, man, like I agree. Like you gotta pay taxes. I mean, the government's there for a reason. There's like all these awesome things that they do and provide to us, and like they do that through you paying their taxes, or you paying the taxes that you need to pay. Like I agree with that fundamentally. That you don't want to be like not paying your taxes like when you should be. Yeah, and like it's the right thing to do. I mean, there's a reason we have taxes, but also, how to explain this, right? So there's like all these different taxes and all these different ways in which you can invest and earn money and like just like behave, spend money, whatever. These all have impacts on the tax you need to pay. And the reason why it varies a lot is because the rules around tax kind of like vary a lot, and there's a lot of like subtleties to it. And you can kind of shout at the government for saying it's super complicated, but it's hard. It's hard being the government. It's hard setting taxes. So give them some credit. But the reason they set taxes in a certain way is because they're trying to encourage certain behavior, okay? So take the example of property. Taxes around property changes like multiple times a year. It's crazy, especially at the moment because, it's a real hot topic, and they feel that property, certainly in the UK where I live, needs improving in like how it's like fundamentally operating. Now you may agree or disagree with that, but the government certainly believes that. And so as a result, they set taxes to alter behavior. So if they're going to like increase the taxes on property, okay, on buying property or like the money you make from property, well, that's kind of like put people off property, right? Because you're going to make less money from it because you're going to pay more taxes. Equally, they could make you pay taxes in certain situations. So, for example, if you're a first-time buyer, if you like never owned a property, then there's like all these actual tax incentives. They like reduce the taxes or like create little like benefits for you to help you buy that first property, because the UK government want to make you, want to encourage you to buy that property. They think it is a good idea that like most people have their first property. Again, you may disagree with that, but that's how the government operates. But then if you've got like multiple properties, they've actually increased the tax there. They put higher charges on buying multiple properties. They've increased the taxes you're paying effectively in the returns you're getting from multiple properties, right? In certain situations. So they're trying to like discourage it, okay? So as an example, if you felt that the tax you were paying from property was like going up, and you say moved your money, your investments, you started to invest more in like other types of assets, like the stock market, gold, something like that, or bonds, rather than property, then that would have a tax implication, right? And you could say move your money to something else, there was less tax on it, right? So for example, an ISA in the UK is like a kind of a bracket where in this bracket, in this kind of like basket, you don't pay any tax on what's in it, right? I won't get into that in super detail, but as a result, you're paying no tax, okay? So what am I trying to say here? I'm trying to say that how you invest, how you kind of do a lot of things, impacts the amount of tax you pay. So if you think about tax, I know that can be hard, if you think about tax in like how you're behaving, then you can do it from a mindful place and hopefully reduce the amount of tax you pay. And that's not a bad thing, right? Like the government have done it to encourage certain behavior and to encourage you to do certain things to reduce your tax, right? Like that's the point of it. So, it's not immoral and it's actually a good thing, right? You reduce the kind of money that you're ultimately paying in taxes, and you're behaving more in line with how the government ideally would like you to behave. You might see that as a good or a bad thing. Okay, I'm moving on before we get into a super tax debate. I know you guys love tax, so I'm going to do like 3 videos just on tax. Only joking. I know you guys are not big fans of tax. But moving on. So we're going to go through like in a little bit more detail diversification. So diversification, like we talked about it, it's like putting money into different things, right? And the idea of that is so that these different things hopefully go up or down in different situations and kind of like reduce your risk. Well, there's different ways we can do that. All right, I'm going to go through some examples, right? So first way is different different assets. No, I'm not saying assets. I'm saying assets. Different asset classes. So you could put some money in stocks, some money in bonds, some money in property, diversify across. You could also diversify within an asset class. So let's say you invested in property, right? You could invest like all your properties, say in London, okay? And 5 years ago, that kind of could be cool because that property in London was doing like super well. But then, in the last couple of years, like London, like not done very well. So flatline, and recently it's actually gone down. Not good. All your properties in London, that might not be such a good idea. You might have a different strategy that might still work for you, but on just that specific area, like that could be bad. So if you invested in property in say like Liverpool, Manchester, Birmingham, London, then if one area went down, London, but other areas went up, say like Liverpool, Manchester and Birmingham, then you're still protected and overall your money is going up. And that's what's happened. Liverpool, Manchester and Birmingham have gone up a huge amount recently, property-wise, but London hasn't. Okay, so a really good example of how diversification can be super powerful, even within an asset class. Thirdly, geography. So I kind of already covered that with the property, but investing in different assets within the class, okay, like property. Geography is like different parts of the world. So you can invest in different parts of the UK, like I just said, or different countries. So you could buy property in other countries, say in the US, in like Europe, that is an example. I wouldn't necessarily recommend that for property because property can be a bit complicated, and especially if you're doing it in another country. Like, it definitely works. I know people who do that, but if you're kind of getting started for investing, maybe don't invest in properties overseas, as a warning. But like, say, investing in, say, like the stock market, right? So investing in companies. So you could like have a fund, right? And this is a good example. So let's take the example of property again. You know, I mean, I've got this this basket of different things in this basket. That's kind of like my fund, right? I might own this basket of properties, say, all over the world, okay? And then I could go out to people and say, would you like to invest in my fund? Would you like to kind of give me £100 or £1,000? And then what I do is I use that money to buy more stuff for my basket, okay? In a very simple way, it's kind of like a way of buying into different things without having to go out and do it, right? Without having to go out and buying properties in the US or Europe or elsewhere in the world, right? You can get somebody else to do it, right? And just take a piece of that, okay? I'll go into that in more detail in another video, but that's essentially what it is. But what you can do is you can invest in things that are not just within what you know. So if you live in the UK and you're just investing in the UK, if the UK crashes, but the rest of the world does well, the US does well, China does well, that's going to suck because all your investments or a lot of your investments are going to go down because the UK economy has gone down. But if other economies have done well, but you've invested in those economies as well in addition, then you diversified, you protected yourself against just one economy. Make sense? Good, thought so. Next one is timeline, like timing. So like, let's say you had, I don't know, £10,000. You know, you got an inheritance, you got £10,000. It's like, right, what am I going to do with £10,000? Okay, so let's say I don't know, I put it in the stock market. Right, I put it in the stock market. And then like tomorrow, that stock market could like halve. It could like drop by 50%. Well, then my £10,000 could drop down to £5,000. That'd be kind of annoying, wouldn't it? That'd be like really unlucky. I mean, it doesn't happen often. So that would be bad luck. But on the plus side, you could do like different timing, okay? So you get your £10,000, you say, right, like today I'm going to put in £1,000. And then next month, I'm going to put in another £1,000. And then in 2 months' time, I'm going to put in another £1,000. And then in 10 months, you've invested your £10,000. And as a result, what happens is, you know, you're splitting out your money over time so that, let's say tomorrow, the same situation happened, the stock market crashed, it halved. Well, only your £1,000 has halved, right? It's gone from 1,000 to 500, which is annoying. Yeah, it sucks. But then in a month's time, you put in your other £1,000, okay? But actually, the market's like super low now, kind of getting a bit of a discount, right? So now you're putting your £1,000 in, okay? And it might go up by, say, 20%, 30%. And then your money is starting to go up. And then you put another £1,000 in a month's time. What you're doing is you're protecting from an event in a particular time and spreading it over a longer period of time, okay? So in summary, you can diversify in many different ways, different assets. Within an asset, you can invest in like multiple different things within that asset. You can invest in different geographies, so not just in your own country, but in other countries. And then you can diversify across time, not just now, but you know, every month or year. Okay? All right. Make sense? Helpful? Good. All right. I'm assuming it's helpful. If it isn't helpful, let me know in the comments. Say, this sucks. I don't want to know about this. I want to know about this, James. Tell me about this in future videos. And then I will do that. I will tell you about those things. But on a serious note, please do let me know. If you like this video, please like it. If you think it's helpful, let me know in the comments. I really, really want to know your feedback. And again, if there is some specific content, some stuff you want to know, some questions that you have, let me know. Put it in the comments, direct message me, and I will look to put those videos out for you in future videos. I'm doing this to make sure you, the person who's watching it, gets the most value from this video, right? So it makes sense for me to know what it is specifically that you want to know. Yeah? Okay. Help me help you. Yeah. And then if there's anyone... that is a bad joke. Or if you know of anyone that wants to know some stuff about this stuff, and you think they might value watching this video or some other videos of my terrible jokes, then share this video, share other videos, and let them know about it. And hey, they might learn something, they might find it interesting, they might be converted to investing. Okay, I'm moving on. All right, so we talked about a few different things. So then how do we take all those kind of things and then say, right, like, I mean, what are we, what's going to be our investment plan? Well, you know, firstly, it's got to be relevant to you specifically. We talked about that in the previous video. You know, smarter investing. You know, what is it that we want specifically in our own life, right? Like, what are we working towards, and how is investing going to best help us do that, right? Then we talked about a few different kind of techniques, some strategies, okay, to invest better. All right, so like based on that, like how are we going to start putting together our investment approach, okay? I'm going to go through this in more detail in future videos, but like I'm going to start to get you thinking about these things. So firstly, which assets do you want to invest in? You know, which things do you like maybe know something about, which feels safe for you perhaps, which fits your like risk appetite, the amount of time that you want to invest in, what assets do you understand, right? Or know how to invest in? What's the split going to be between those assets? Is it going to be like 50-50 between two? Is it going to be like 33-33-33 between three, 10-10, 80, whatever, you know, like what's the split going to be between those things? And then are you going to invest like a whole load of money up front because you've got some inheritance in? You're going to split it out over time? Are you earning money each month and then saving it, and then you want to invest that money each month perhaps to diversify across time? And then how are you going to set it up, like logistically, right? So you want to invest some stocks and property. Like, how do you do that? Are you going to go invest in some specific stocks? Are you going to invest in a fund? Are you going to invest in a particular property? You're going to invest through somebody, through a company, loads of different ways. And I'm going to talk about that in more detail in future videos, because like a lot of you guys might just be thinking like, I literally just don't know how to invest. Like I see this all the time. They're like, it's like, how do you even do it, right? I mean, what, like, do I just call somebody up? I mean, yeah, I mean, there's different ways, right? So, you know, we'll go into some different examples and how you do it, because like, I want to focus on the practicalities. I don't want to get super theoretical, because then you're not going to have to take action, right? So yeah, that's important. All right, so some key rules to follow as part of investing. First one is you want to build up a critical mass. So what do I mean by that? Critical mass is at the point in which it becomes powerful. It becomes it has epicness. It's epic at the point at that mass. Okay, what I'm trying to say is that you want to accumulate your wealth, build your wealth up to the point in which it is achieving what you want, which is usually for most people financial freedom. And the first level is what? Financial independence. How much money you need coming in to meet your obligations, how much, like your cost of living, okay? So usually the best way I advocate is build up a pot of money, like a certain amount of wealth that you can convert to regular income each month that meets your cost of living, okay? So that amount of money you need is kind of like your critical mass. At that point, you know, it grows more than your spending at your current cost of living, even if you didn't need to work. Okay. Second thing, avoid heavy management fees. So, you know, a super common way of investing is like through a fund or through like a broker or some kind of intermediary. Right? It's just like somebody who's facilitating it, because, you know, you can't just go out, say, and be like, oh, hey, Tim Cook, can I buy some Apple shares? He's, you know, the guy's busy, you know, you also don't have his direct dial. So, you know, you're going to have to do it through somebody. You have to like call somebody up or go on a website or something, like through an intermediary. And those intermediaries, that person helping you, they're going to like charge you money, right? So those fees, those management fees, like come in all different shapes and sizes. There's like transaction fees. There is fees to have it through some kind of website or organization. There might be like currency fees, there might be like holding fees, liquidity fees. They come in like loads of different words, and they purposely make them super vague and confusing and hidden and in like terms and conditions. So, I mean, I could do a whole video on this, but all I want to say is that be careful around fees, and like always check. If you go to invest, just think like, what are my fees as a result of what I need to do to invest in this thing and the way I'm investing, okay? And it's not often just that one number that they're like showing you. Usually what they do is they show you like a super low number that's like really obvious, and then like a whole load of other numbers like hidden, okay? It's a common tactic, okay? So just get clear on that, get like informed as part of investing, okay? Because reducing those fees means that that's less money that's disappearing and more money in your pocket, in your pot of money, and the quicker you can get to that critical mass. And these fees often, like a common issue I see is that people think, yeah, but like fees not very much, 1%, 2%, 3%, but like 2% fees is huge over the long run, right? If you're building wealth, that 2% now is like, yeah, whatever, but 2% like coming out of your pot of money over like say 20, 30 years is like thousands, like hundreds of thousands of pounds for some people, based on the numbers that they're building and they're working towards, right? So like fees are important. You want to reduce those. And then thirdly, diversify. We talked about it loads, but like I really encourage that. Yeah, you know, there is certain arguments to focusing on one thing, getting super informed and kind of investing in that one area. It's kind of like what you do often a lot of times with jobs, but even then it can be dangerous. And I get having one thing that you're going to prioritize maybe, or like focus on, that's fine, that's cool. But if you just put everything into that one area, it's super dangerous. And the reality is all asset classes at some point in time previously, historically, have like epic failed, okay? And often we just didn't see it coming, and that usually is part of an epic fail, right? Like if something crashes loads, it's usually because we've not seen it coming. Because if we saw it coming, then people would have come out of the market beforehand and it wouldn't have dropped so much, okay? So what I'm saying here is, even if you think you know everything about that particular area, then believing that's always going to do well, or even now, like 100%, is a dangerous way of thinking. Like definitely diversify, even, you know, a small amount to protect yourself and give you that cushion in case something bad goes wrong, okay? Next, don't lose money. You know, Warren Buffett's super famous for saying rule number one, well, sorry, there's two rules. Rule number one, don't lose money. Rule number two, don't forget rule number two. That was like super simple, I messed it up. Okay, if you didn't know already, rule number two is don't forget rule number one. All right, like, I mean, the point he's making here is that like don't lose money is really, really important. I know it sounds really obvious, but why he's making the point and why I'm making the point now is that losing money is easier than making money. Okay, so what I mean by that, this is a lesson that like most investors go through. I've definitely gone through it, because when you don't have any money, or you're in debt, or it's a small amount of money, then you don't really care. You're just trying to make the most money possible, and you can't really lose money or a substantial amount of money because you don't have money to lose. But as you build up that money and you get to 10, you know, 100,000, 500,000, £1 million, whatever it is, then that's a lot of money, right? And then whatever you're investing in, that money could go down, and the more money you have, the more money you can lose making a bad decision. And making a bad decision or losing money as a result of what you've done is like easier than making it. It's easier to lose it is to make it. That's kind of like the name of the game. That's you know, it's just the way it works. So I guess I'm trying to like help you learn the lesson without having to have experienced it yourself. So as you build money, as you build wealth, just make sure, like, is what I'm doing like an effective way of investing, and is there any risk of me like losing money? or like losing a lot of money. I always think, what's the risk? Is there a risk there? What's the risk? How likely is it? What can I do to like mitigate that risk, to like make sure that risk doesn't exist? Okay, it's just like really important. I definitely learned that mistake a couple of times. I lost a lot of money. It's very painful. And then I realized firsthand, yeah, it really is easy to lose money, and it's really annoying because it, like, you know, it took me a lot of time and effort to make that money, right? And I lost it very easy. So, you know, now I make sure I don't get into those situations in the future. And I don't want you to be in that situation either, okay? So, moving on. Next one is asymmetrical risk reward. So what I mean by this is that it's not symmetrical, okay? Now, a common thing people tend to think around this subject is that, okay, I want to make more money. I want to get a higher reward, a higher return. Okay, so for me to do that, I need to take more risk on, because as I get a higher return, then inevitably I'm getting a higher risk as a result. Or if I'm lowering my risk, then what's happening is I'm going to like get a lower return. Now that kind of is true, and you see it, right? So like low risk investments tend to give a low return. Higher risk investments tend to advocate a higher return. So, you know, there is some truth there, but it's not like direct. It's not like, you know, if you go from 5% return to a 10% return, irrespective of the investment, you're going to double the risk. That's just not true. That's not the way it works. They're both subtle. There's a kind of like an indirect influence over each, right? So asymmetrical risk reward is the concept that you can increase the reward or increase the return and keep the risk the same, okay? Or you can reduce the risk, okay, and maintain your level of reward or return, okay? The point there, and like there's like millions of different examples of this, okay? And I've seen it, like all the different things I invested in, like the returns I get from them like vary hugely over like the expected returns, historical returns, and the level of risk I'm taking on. Because the level of expected return is one influence over the like risk. Okay, turn it another way. The expected return you get is influenced, okay, I'm going to start again. Risk, okay, this concept of risk. One of the things that impact it is the amount of expected return on that thing that you're potentially investing in, okay? But there's a whole load of other things that impact the level of risk or perceived risk or real risk of this thing, okay? Like what political economy we're in, which country you're in, how much you know about it, how informed you are, what specific investment it is, you know, whether that market generally is doing well or doing badly. There's like a whole load of stuff, okay? It's not just expected return. So what I'm saying here is, don't just assume to get a higher return you need to take higher risk, because if you have that assumption and you pursue higher returns, you will inevitably get higher risk, because that's the way you see the world. But if you see the world like there is the ability to get a higher return and reduce your risk, you have that view, then when you go looking for investment opportunities, then you will find opportunities that have a higher return with a low risk, okay? It's kind of like what you focus on, you find, right? Maybe not initially, but being aware of that improves what you find, okay? And then lastly, tax efficiency. Talked about it loads earlier on in the video, but super important, a really important rule to follow. Okay, so in summary, what have we gone through? We've gone through some really important investment strategies, things that you need to be thinking about to improve how you invest. We've then talked about then how you take all those considerations and start to think about how you're going to put together your specific investment plan, right? Like how you're going to take your money and invest it, what you're going to invest it in, how, over what period, and so on, right? Using these considerations to make a plan for yourself specifically. And then finally, we talked about some of the rules that are like really important to follow to improve how well you invest. All right, so that's all from me. I hope you enjoyed this video. If you did, like it, comment, let me know, direct message me. If you want some specific videos, again, let me know what specific content you want. If stuff wasn't clear in this video, let me know. I'll explain it more in detail, either in a future video or directly to your questions. Again, if you think somebody you know would benefit from this video, share it with them, share it on your page to your friends and so on, and spread the message, because I want to make sure that I'm adding as much value to you guys watching this video and to as many people as possible. All right, that's all from me. I hope you enjoyed this video. Take care. Enjoy the rest of your day. Bye bye.